Wizards of the Lal Street is back, and the focus of this series is to feature some of the finest young investors who are likely to make a mark in investments in the years to come. Ramesh Damani caught up with Rahul Rathi, the MD of Capmetrics, and began by asking him about the role and power of numbers in investing.
Numbers are a measurement of an outcome. If you look at companies like Asian Paints, HDFC Bank, Bajaj Auto, Infosys,
Sensex companies, all of them.
They've all returned more than 250. Bajaj Finance, they've all returned more than 250 times since inception. That's a number. And why have they returned these kind of stellar returns is what other numbers show.
And there are two kinds of businesses that you look at. You divide them into two ways. Tell me about it.
Right. There are two styles that are there prevalent in investing. One is investing in a business and another is investing in the businessman. What do you look at when you're investing in a business? You look at an 11-year history, because an 11-year history is a GDP cycle where GDP has gone up, GDP has gone down, and GDP has drifted. Within the 11-year cycle, how is the business done during bad times, during good times, and drifting times?
11 years captures that?
11 years captures the whole cycle.
Right. What do you look for beneath that number? You get an 11-year snapshot. Now what are you looking at?
The key metrics that we follow to know whether the business has created wealth is how has its operating cash flow grown. Operating cash flow is a number that tells you what is the cash that the operations generate from the business.
Is there any sectors that are more prone to higher returns on capital, better cash flows? So only look at those businesses as opposed to other businesses?
The way I divide my universe is I have government-led GDP growth and consumer-led GDP growth. I believe that the consumer-led GDP growth is secular in nature and GDP growth is not volatile. So we will invest in companies that have a consumer orientation to it.
Rahul, you have a great career. You've analyzed stocks. You looked at it differently than most people. Give me some learnings that you can share with us.
Right. So the biggest learnings have come from the mistakes that I have made. And one of the mistakes I want to share is Jammu and Kashmir Bank, where data and the outcome did not match. So what should we be careful about? If you look at GDP of Kashmir, it is 30% higher than India's GDP, driven by two drivers. One of them is the defense spending.
Other is tourism.
And the next is tourism. In Jammu and Kashmir, J&K Bank has a clear monopoly to be able to recover money whenever they wanted. But as soon as they started lending in Bombay and Bangalore, the recovery mechanism in Jammu and Kashmir did not work, and their NPAs were much higher than expected. So we learned that late, and that's why we...
So what was the learning there? That data itself is not enough?
That is true. What we want to see is their current execution and their history. Are they in sync or they're different? If they're different, we need to reevaluate whether the capability, what we are investing in, is what the history matches.